Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob. Hope you had a great Canada Day. And for our American listeners, I hope they have a great Independence Day.
I hope so, too. Yeah, we had dull weather here on July 1st, and there's dull weather here today. But I think Saturday and Sunday are going to be nicer, which is good to look forward to.
Yes, and kind of a very Canadian day for me. I spent the afternoon doing a harbor tour on a paddle wheeler boat in New Westminster.
Oh, that would be nice.
Yes, and it was misty out. It was picturesque, is the way I would put it.
Yeah.
Bob, our first listener question comes to us from the Netherlands. Willem Gruters says in his email, I know that in 1980, wow, you had fans then. I know that in 1980, Mr. Hoye thought that no matter how much the Fed would print, stocks would outperform commodities. Can Mr. Hoye give the main reasons why he thought this would happen? Was it interest rates going through the roof at the time?
Yeah, that was a major event, and just to back up and think on the 1970s was a decade of horrendous inflation in goods and services, wages, houses, groceries. And the problem was, of course, the price of inflation was going up faster than wages were. So it was becoming very uncomfortable. And with that, interest rates were soaring, and the yield for the long bond got up to 15%. And in the 200 years before that, the high yield in the senior country was 6.5%. So that was pretty ugly. But then, when presenting our research to institutions, I included a slide that was the wrap-up for it, and it did say that very statement, that the next big game would be financial assets, not tangible assets. And Willem asked what was behind that decision, and it was quite simply that's what happened before. You had a huge commodity boom complete in 1920 and crashed real hard, and then out of that came the big game in financial assets, another new financial era. So that then pushed the prices of stocks and bonds up, and they way outperformed commodities. But then that was 1929 was the fifth example of that pattern, because it first shows up in 1711, where again a global commodity boom, and then 9 years later a stock bubble, the very first one. So it was just simply the way financial history works. You get a decade of extraordinary rise in commodities, and it ends, and you end up in a period of inflation in financial assets, which we have been in since, with a terrific booms in commodities completing in 2008 and 2011. So the next step, and I'll add this one, is that once the boom in financial assets is over, and this one seems to be completing, then it's a deflation in everything. And that's been the pattern for 300 years. So this is where the old community of inflation is looking at the recklessness of the Fed and pumping out cash out the window, and in their world, this is going to drive commodities up and gold up to $10,000. I saw Record the other day came out with that $10,000 forecast. I think it's going to work as the same as it has in the past. Deflation in all assets except gold, which real price of gold up, as it has done in the past, setting a long bull market for gold stocks. So I think I think this will work out yet again. So we're going into the period where stocks and bonds go down, inflation goes down, but the real price of gold goes up, making for a very good market for gold stocks.
Two questions come to us from Michael. His first question: Bob, I maintain a core position in gold, but it seems like it may be time to lighten up on the gold miners and silver. I fear that another leg down in the overall equity markets will drag silver and the miners down as it did in March. Do you anticipate this may occur again?
Yeah, Michael, you could write a paragraph for us in next week's letter. That would be basically it. The gold sector, of course, all sectors kind of bottomed in the middle or third week of March. Very oversold. And what we used then was that typically a period of very heavy liquidation in the financial markets would run about 2 months, suggesting that the end of March would be the end of the heavy forced selling. I think it bottomed on March 23rd. March 19th, we put out a piece called Bottom Soon or something like that. So, yeah, you're right on this one. The action has become terrific in many sectors, and particularly the crazy high-techs, the big high-techs, the huge five, and also in the gold stocks. So they overbought. The technicals have been wonderful, and it's time to take a little money off the table in the precious metal sector.
The second question from Michael: although CNN's Fear and Greed Index is currently neutral, I've noticed an extreme level of bravado in the comments sections of many financial blogs. Is this high level of bravado a contrarian indicator? It seems that a bravado index would be useful.
Yeah, Michael, listen, if you're looking around, you could come up with a bravado index. What happens is that in May, our momentum indicators reached excesses, like we call them upside exhaustions. Now, that is a condition that's in the market, and it doesn't necessarily mean that the market's going to get killed tomorrow. But, like, for example, the New York Stock Exchange Composite set its high in, I think it was June the 8th, like that. But our work in May came out, used the old line, sell in May and go away. And we noted that financially speaking, May could have up to 8 weeks. So it looks like the market, using the New York Stock Exchange comp, might have peaked on the fifth week in May. We'll leave that little bit of drollery with you. But Michael, I would look forward to you working on your bravado index.
And we also have a question from Kathleen. Kathleen's question to Bob: as widely reported, publicly traded corporations have been on a frenzy buying back shares in recent years, largely by issuing bonds to raise the cash needed. Now many of these same companies are in a reverse frenzy, issuing new shares for sale to the public to raise cash. Many analysts predicting that many of these same corporations will be buying back these shares again in the future with new additional cash raised by selling bonds directly to the Fed. This all seems like a rather convoluted way of increasing shareholder wealth. Bob, can you actually explain what's going on here?
You've done a good job, Kathleen. The buyback game really was underway because during the Obama administration, the economic growth was pretty dull. And then the people became ambitious, and with the dull growth and the the Fed pouring money into the system thinking they're going to make good growth, the extra lolly went into speculative items like the stock market, but they were enhancing it. The forcing of credit into the markets artificially lowered interest rates, so it was a wonderful recipe of being able to borrow money very cheaply, any amount, and buy the stocks. So like Boeing ended up buying $45 billion worth of stock, and they pinched the pennies on doing the modifications to the 737 airliner, it was plain foolish. And so now you've got a different, and this is what Kathleen is pointing out, there's now a different buyer for the bond, with the Fed buying treasury corporate bonds. Yeah, the game is still possible. I'm not certain as to the last few months how much of the buyback stocks thing is doing, but I think that was symptomatic of an unusual situation in the financial markets that may not be around for too much longer. Again, the old saying, sell in May and go away, we thought that things would, once the rally started in March, we thought that things would be positive out to mid-year. And that in August, we would begin to look for seasonal weakening in crude oil and base metals, lumber, that sort of thing, and taking the markets down with it. So it's been a wonderful rally, and people should be taking some money off the table.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, a U.S. Main Street lending facility said it's had little action. Why not?
Yeah, they were designed for Main Street, to put money into Main Street, because the problem is that you had the horrendous shutdown of the economy, and what's happening is that there's little interest in borrowing the money. Many corporations, many businesses are getting defensive. And this was the case in 1929 as well, where in August of 1929, the Fed raised the discount rate from 5 to 6%. It was a belated move because the T-bill rate was already started down. But within that, the New York Times had an article on it, and the policy was to tighten money to Wall Street, which was speculative, but they also knew that they had to ease money for Main Street businesses, which they attempted to do. But then when the financial contraction started, that was it, game over, Charlie, so they couldn't do anything about it. So this is the point of that headline was that they have made a lending facility available for corporations and it's not being used.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the U.S. Fed has renewed its pledge to keep interest rates low. What does that mean?
It means they're flaming idiots. They got this theory that a perfectly timed cut in the Fed funds will keep a boom going. And of course, we're saying that this is within the context of a boom, and they really believe it. In September of 2007, the head guy at Harris Private Bank in the States said that the Fed will cut rates, and it's a certainty that it'll help the stock market. Well, that's the theory. But if you take a look at just straight ordinary T-bill rates, those are short-dated, high-quality instruments that trade, that market rates that trade all of the time. Interest rates go up in a boom and down in a contraction. And so what you have here, for example, in 1929, the T-bill rate went up into May, and then it turned down. And then by about July, it was down far enough that retrospectively you could say the trend had changed. And that was saying that the boom had maxed out, and then that there would probably be difficulties in the fall. So this is the same thing here. Last year, I think it was March, when T-bill rate set its high and turned down. And then it was down for a few months, and then in the summer, the Fed made great noise about cutting rates in the face of a strong economy. But we argued then that the reason why the Fed was cutting the rate in a strong economy was because the T-bill rate had come down, and they had to look like they were in charge. So that one is an indicator that the theories have no relation to market reality, and what you want to take a look at is that it's when the Fed was first promoted in the early 1900s, the movers and shakers then knew that a financial crisis preceded recessions. So they came up with the theory that with the Federal Reserve as the lender of last resort, then it would fix crises. There'd be no recession. And it's a very appealing theory, and it's repeated. Generations of economists have repeated it. Generations of financial writers have repeated it. But it doesn't work, because we are now, it's not in the 19th recession since the Federal Reserve opened its doors for business in 1914, and that means there's been 19 failures of the theory. But here you still got the headlines that, oh, the Fed will fix everything by lowering interest rates. It's so absurd, I can't believe it. But it's always entertaining to watch them come up.
Bob, if low interest rates were so helpful, Japan and Europe with either flat or negative rates should really be booming, and should have been booming the last 10 years. That didn't happen.
That's the theory, isn't it? But you want to take a look at post-1929? The T-bill rate fell eventually in a few years' time to 0.08%, effectively zero. And the Fed discount rate fell hugely. I can't remember exactly what it got down to, but there's the example. Now, here's one other irony on this one, is that as with September 2007, the headlines about that the Fed was going to do an interest rate cut got people buying the market, as it was last summer when the first discussion of a Fed cut. But again, you look at the record and you plot a chart of the S&P against the T-bill rate, and what happens? The fastest declines in stock prices are accompanied by the fastest declines in interest rates. I mean, these guys are absolutely idiotic, that they cannot learn from evidence, real evidence, and they stay with a theory that hasn't worked for over 100 years. It's pathetic. I mean, I just can't believe it. And anybody with common sense, if you take a look at the record, you're going to see the same thing. So anyways, the establishment and their peculiar theories will continue to entertain us.
Bob, thank you so much for being on the show.
Yeah, Jim, good to be with you. And you've got the fog at your level at home, and you've got the rising river at your feet. How are you going to survive?
Maybe move up another story.
No, I'll give you the advice my sister gives me whenever there's adverse weather. She says, stay indoors and drink lots of fluids. So there's my advice.
Thank you, Dr. Bob.
Okay, talk to you next week.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. As you just heard, Bob loves to answer your questions. You can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.